Hello fellow investors and passive income investors, welcome to today's update. Today's update is going to be on Hamilton ETFs and changes that they've made to HYLD, and also there is also special dividend announcement today. So I'm going to show you these changes that they've made, what effect, what impact they have for you as a passive income investor or as an investor who is investing in these ETFs, and what benefit you might have. So those are the kind of things I'm going to look. So if you stick around, you're going to learn a lot in this very short video, but has massive information packed into it. The first thing we're going to look is Hamilton enhanced cover call ETF price. Today is about $11.99, but we look at the 52-week range is between 1280 to 1115. That's the lowest has gone, and the highest is gone within a year is 1280. So that's the price we have for today. If you want to buy, that's a price. For people who don't know about this ETF, it's an ETF that invests in pretty much US equity, and also does write calls, cover call ETF, and when they write those calls, they generate income which they pay monthly. And we look at the yield right now is about 11.98, which is about 12%. We look at the sector that invests. I've mentioned that before. There's technology, about 30%, healthcare, there's consumer discretionary, there's a financial, there's communication, there's industrial, consumer staples, energy, there's utility, real estate, and material. So, and these are the ETF that they invest under, because this is fund of funds. We look at the management fees on about 0.65%, and distribution they pay monthly. If we look at the distribution history here, we can see that the last time they paid was December 7th, 2023, and they paid about 12 cents. So that's how much they've been paying for the whole year. Before it used to be 14, they decreased a little bit. So that's brief of that. Before I'm going to show you the changes that they've made to HYLD, I'm going to give you an update on the special dividend that they announced. So Hamilton ETF announces estimates 2023 special cash distribution. That was an announcement that just came out yesterday. So Hamilton ETF is pleased to announce today estimate cash distribution for the 2023 tax year. Right, they're going to pay those dividend in cash, and is going to be on these two ETF, Hamilton Australia Bank Equal Weight Index, which is HBA. They're going to pay about 0.79, about 79 cents per unit, and Hamilton Canadian Bank Mean Reversion ETF, which is HCA, they're going to pay about 17 cents. So the reason they pay these ones is because whenever there's a cash, there's an extra, right? By law, they are allowed to, the ETF are required to distribute any net income and capital gain earned in a year. So whatever those capital gain, they have to pay, and that's why they pay. So whenever there's excess, they have to pay those special dividends, and that's what they're going to pay today. So, and of course, the record date for this one will be on December 28th. So if you don't own any of these before December 29, you have to buy before December 28 to be able to be on the record on December 29, and then you're going to receive your dividend or special dividend in 2024 in January, early January. So that's update on the dividend and the special distribution. So now that special dividend announcement or update is out of the way, now let's look at the changes that they've made and what impact these changes will have to your portfolio. So we look at these was as of at September 29, 2023, and this one is as of November 30th, 2023. So this is an updated one, and this is a previous one, right? So I made a video, and then I told you that they're going to have these changes, and the changes that they've made is that they remove certain ETFs here. So the ETF that were removed was HYLD right here. It's been removed, eliminated, and also there is QYLD, this one here, QYLD. These two have been eliminated, and then in place of that they replaced a brand new ETF that just came, and I made a video about this one, was SMAX, which is Hamilton US Equity Yield Maximizer ETF, and also they added a QMAX, which is Hamilton Technology yield maximizer. And I literally when I made this video, I told you guys, of course, the world changed, and that's exactly what they did. And we can see here, for example, JP Morgan equity premium right now is 18, but previously it used to be about 19% of the portfolio. We look at the JP, which is JP Morgan Nasdaq equity premium, was 19, but right now it's only 15. So they reduced those ones, right? And we can see QMAX is taking about 9%. And SMAX has taken about 17%. So the Canadian ones, which is Horizon Nasdaq 100 cover call ETF, is the same percentages last month previously, and also Horizon US large cap equity, it remained the same, about 17%. But all the US equity ones like a JP and also JP Morgan equity premium, it was reduced a little bit because of the fees and overall cost. So we've seen that the Hamilton ETF has made some changes to this ETF. The reason that they made the changes, I've mentioned that in my previous video, is that because whenever there are ETFs, especially the ones that are traded on a US exchange, first of all, Hamilton is a Canadian company, and also it holds Canadian. Most people who are investing in this one are Canadians, so they have to take those Canadian dollars to actually buy those ETFs. So I mean, there's conversion there, and so there's added cost to it. So that's why they're going to, since they already have in-house ETF like SMAX and QMAX, which these ETFs, they're pretty much invest in US equity, so it's pretty much the same, but they're in Canadian dollars, so there's no other exchange. They've already done exchange there. So because it's in the house ETF, it reduces cost, and that's one of the reasons why they change those ones. And the other reason is because when they have an in-house, it's more easier to manage. And what's the benefit? All of this, what all this will benefit you as a passive income investor. One of the benefits is that because there's a reduced cost, right? So they're going to have extra money, and that money, of course, was coming to you as a passive income investor, right? And that's the thing. And also there's a performance, because these ETFs, they seem to be a drag on the portfolio. By removing this one, they are hoping that the portfolio right now is going to perform well. I mean, overall portfolio. So these are the three benefits you're going to receive as a HYLD investor or HYLD prospect investors. If you think about investing in this one, you're going to receive, first is cutting cost. So cutting cost meaning there's more money being left for the fund to pay more in ETFs. That's one. And this second, the second is going to be that they are going to have easy way to manage the portfolio. And the third is going to be that the portfolio will perform well because overall cost has been reduced, and so you don't have to pay that much. So those are the changes that they've made in the special dividend, and that's a just update. I just want to give it to you. So if you have any question, or if it's your first time, just make sure you subscribe. And if this video has any value to you, just make sure you smash that like button. Till we meet again, I always bring this update. So bye bye.